Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hi, this is Kevin Roskam with USA Financial, and this is your June Trending Report, June of 2025. Hard to believe that time is moving so quickly as it always seems to. Wanted to spend some time with you this month talking about, you guessed it, trending. Why do we think about trending so much here at USA Financial? Why do we talk about formulaic trending and unemotional investing and a disciplined approach to long-term money? Well, if you've watched the news at any point in the last several weeks, you know the answer to that. Because one of the things that we talk a lot about, and I shared this image with you last month, was the cycle of investor emotions. It's really important for us to understand what investors go through, not just as advisors or third-party money managers, but it's also important as clients to understand how this works. And as we look back over time, we look at really going all the way back, depending on your age, to 01 to 03 with the tech bubble. When we look at 2008 into 2009, 2020, 2022. When we look at the market cycles, this cycle of investor emotions tracks very closely to what the market does. The idea, of course, is that somewhere as the market starts to fall, there's anxiety. We start to get a little nervous. We've had a good run in the market drops a little bit, and we start to think, well, is now the time to get out? Was this the top? Should I be nervous? What should we do? And if eventually, we lose a little more money or the market goes down a little further, and our initial thought is denial. No, that's okay. It's going to go back up again. Everything's going to be fine. And of course, at some point that turns to fear. Whether that fear point for you is at a 10% drop in the market or a 15% drop in the market, wherever that point is, after fear comes desperation and panic. And once we get to the panic point, that capitulation, somewhere between capitulation, despondency, and depression, is when typically we want our assets out of the market. Whether we do that ourselves or whether we've employed third-party money managers, we expect them to be out of the market by that point. Once we get down to that depression stage of the market being down, then there's a rebound point. And again, we don't know exactly when this is, but at some point as the market starts to turn or headlines get positive, if that's possible anymore, what we see is we start to have a glimmer of hope. Maybe I should get back invested in the market. Maybe now is the time for me to feel better about exposing my money. And then the market starts to go up a little more again, and we start to feel that relief. You know what? I think things are turning around. I'm pretty optimistic about where the market's going. And that optimism turns to excitement. That excitement, as we see our assets growing again, or we see the market moving up again, turns to thrill. That thrill turns to euphoria, and we start all over again. We can't control investor emotions or even our own emotions a lot of the time. But if we can recognize where we are in this cycle, not just the stock market cycle, but the cycle of our own emotions, we have a chance to control them in order to stick with the plan, in order to get to the long term. I've often said short-term emotions kill long-term plans. Well, the other thing I think that's important to realize is that if we put a long-term plan in place, evaluating it every 6 months isn't a fair determination to know whether the plan was successful or not. And so hopefully somehow by controlling our emotions, we have the chance to get to the long term to see success. Now, what I'd like to show you is one of the indicators that we track. Risk management means caution. A lot of times when we get into risk managed strategies, we get into them because we want to avoid catastrophic loss. Catastrophic loss means different things to different people, but we love the story of risk management when we think about the market falling apart. We love the story of an exit strategy when that exit strategy gets us out of the market after the market's been down a little bit. And so what all these trending tools are meant to do is measure different things in the economy or in the stock market, and based on those things, get us in or out of it. So what you're looking at here is a trending tool that puts all of the things they measure in a number scale. And what you see, a green line that says bull, and the number behind the bull is 55. And then the bear line is the number of 45. And so in between that bull and bear is a threshold. On the way down, the number has to get below 45 before we would get out of the market. And then on the way up, really as a caution to make sure we're not just chasing the market, the score has to go all the way through that threshold to get to 55 and end the week on 55 or higher for us to get back in. This is cautious because once this indicator goes negative, it wants to make absolutely certain that market conditions have smoothed out to the point to expose us to the market again. Something I always used to talk about, I live in West Michigan, as many of you know, and in West Michigan, we don't have mountains. We have to drive a couple of hours if we're going to ski in the wintertime. And so the older you get, the less you can do in the winter. And so what I like to do is ice fish. But I'm not a small person. And so because I'm not a small person, I wait to see other people on the ice before I will go test the ice. That's risk management. Risk management for me means that I don't get that first ice great fishing. It means that I will miss some of the best fishing of the season, which is first ice and last ice, because I value my life more than I value an 8-inch bluegill. It's the same thing in the investment world. Risk management means that we aren't going to catch things at an exact perfect time. It means that we're going to be cautious. And in the name of that caution, we're going to miss some of the upside, but we're also going to take part in some of the downside because we want to be certain that a trend is occurring. This type of trending overlays that cycle of investor emotion, because usually we get out before the despair somewhere, and I'll go back to that slide, we get out somewhere between denial and desperation, because the trending mechanism wants to make sure that a trend is actually occurring. And it works the same way on the other side. We typically get in somewhere around the optimism stage because we want to make sure that this market recovery is real and sustainable. And so what that means sometimes is that as an investor, our emotions get the best of us and we say, you know what? This long-term plan that I'm in the last 2 months has not been good for me. maybe I should change the long-term plan because of something that happened in a 2-month period. And I'm here to encourage you not to do that. Because if it was a good plan when it was set up, and if you're taking the appropriate amount of risk over time, it should be a good plan over the long term. And that brings us to the trends. What are we seeing now in the marketplace? And so, as we do every month, we look at the last month in the S&P 500. And the last month in the S&P 500, what we see is this continuing uptrend in the stock market. Is it an uptrend in the economy? Or isn't it? At some point, it doesn't matter. We saw that in 2020. The market, the economy was terrible by every stretch, especially in the second quarter of 2020, but the stock market went up. We're experiencing a little bit of that now, where the stock market's going up, even though there is still uncertainty. And so in that uncertainty, some trending tools are taking longer than others to expose our assets to that uncertainty. We look back at the last year. And looking back at the last year, it should make sense. Look at what's happened since February of this year in the stock market. I emphasize that because a lot of the stuff that's going on in the economy is headline driven. Regardless of your politics, have the tariffs hurt our economy, or has the scare of the tariffs hurt our economy? Regardless of what your answer is, look what the stock market has done since about, middle of April to end of April to now. It certainly seems to be recovering. But even in that recovery, just look at the last 12 months. What you see is volatility. Now, we know volatility is the cost of growth, but in the name of risk management, we try to avoid some of that volatility, which a lot of the money managers did in some way or another in the last 2 to 3 months. And so what's the market trend doing? Well, the overall trend looks to be positive, but there are certainly bumps along the way. And that's why when you use money managers that do market trending, I think it's so valuable to use one that will make daily evaluations. Where's the market headed? How are we invested today? You can use ones that use weekly evaluations. How are we exposed to the market this week? There's monthly evaluations. There's quarterly evaluations. And then, of course, with a portion of your money, you can be exposed to the market all year round. But the trends have shown that over time, we're still experiencing the need for risk management, the need for unemotional investing, and the need for a disciplined approach. Because over the course of the last 5 years, we've seen a couple different significant market drops. And the value of having an unemotional, disciplined, formulaic approach to give us some consistency during volatile times is what will get us to long-term success. And so as you see this video in June of 2025, there's a lot going on in the world. There's a lot going on in the United States of America, and there's a lot going on in the economy. Everything that's going on was planned for in your long-term investment strategy. If your long-term investment strategy approach is to be disciplined and unemotional and use formulas to determine what and when to be exposed to the market, you have a chance for long-term success. This is Kevin Roskam with USA Financial. This has been your June trending report. Thanks for listening. I look forward to seeing you next month.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.